Hi, I'm Phoebe. Welcome to today's lecture on the 2008 recession. The 2008 Great Recession was one of the most significant global economic downturns since the Great Depression of the 1930s. It fundamentally altered global economies, exposed systemic weaknesses in financial markets, and reshaped monetary and fiscal policies worldwide. This lecture will explore the causes, effects, and aftermath of the 2008 financial crisis from a macroeconomic perspective, providing students with insights into the interplay of housing markets, financial institutions, government policies, and global economic forces. Overview of the Great Recession. The 2008 Great Recession, also referred to as the global financial crisis, officially began in December 2007 and lasted until June of 2009 in the U.S., though its global impact continued well beyond that. While it was triggered by the collapse of the U.S. housing market, its roots lay in broader global financial practices, leading to the failure of large financial institutions, severe contractions in credit markets, and massive government interventions. Preceding economic context. A housing bubble. The 2000s saw a rapid increase in housing prices, particularly in the United States. Several factors contributed to this housing bubble. Low interest rates in response to the 2001 recession and the 9/11 attacks. The Federal Reserve lowered interest rates, making borrowing cheaper. Easy credit access. Banks and financial institutions were eager to provide loans, often with little regard for creditworthiness, creating subprime loans for borrowers with lower credit scores. Lax lending standards. The growth of mortgage-backed securities, MBS, led to a relaxation of lending standards, as banks sold off their loans, transferring the risk to investors. Global imbalances. The U.S. ran a large current account deficit, while countries like China and Germany ran surpluses, recycling excess capital into U.S. financial markets. This created an environment of low long-term interest rates, contributing to riskier financial behavior. Key causes of the 2008 crisis. Subprime mortgage crisis. The housing market's collapse began with the failure of subprime mortgages, home loans granted to borrowers with poor credit histories. As interest rates began to rise, many borrowers were unable to repay their mortgages, leading to widespread foreclosures. The value of homes declined, creating a negative feedback loop, where falling home prices exacerbated the defaults. Securitization and financial instruments. The rise of complex financial products, such as mortgage-backed securities and collateralized debt obligations, CDOs, meant that risk was dispersed across a broad range of financial institutions. While this spread risk, it also made the global financial system more interconnected. When subprime borrowers defaulted, the value of these securities plummeted, triggering large losses across banks, investment firms, and insurance companies. Leverage and risk-taking. Many financial institutions engaged in highly leveraged investments, borrowing large amounts to amplify profits. This strategy magnified losses when the value of mortgage-backed securities began to decline. Lehman Brothers, for example, had borrowed 30 times its capital, meaning that even small declines in asset prices had catastrophic effects on its balance sheet. The role of credit rating agencies like Moody's and Standard & Poor's assigned high credit ratings to risky financial products, such as CDOs, contributing to the belief that these assets were safe. When these ratings were revealed to be overly optimistic, it further damaged confidence in financial markets. Global financial interconnectedness. Globalization had tied financial markets together. The collapse of the U.S. housing market had ripple effects across Europe, Asia, and other regions, creating a global financial contagion. Banks and institutions worldwide had invested in U.S. securities, and when those assets failed, it led to a global liquidity crisis. Consequences of the Great Recession. Bank failures and bailouts. Lehman Brothers, one of the largest investment banks in the U.S., declared bankruptcy in September 2008, marking a key turning point in the crisis. The failure of Lehman Brothers sent shockwaves through the financial system, leading to a massive loss of confidence and an immediate credit freeze. Bear Stearns, AIG, and others, financial giants like Bear Stearns and AIG, were either bailed out or taken over by other firms. The U.S. government had to step in to prevent further collapse. Global banks, European banks such as RBS and Fortis, also faced insolvency, requiring massive government support. Stock market collapse. Global stock markets lost trillions of dollars in value during the financial crisis. Between 2007 and 2009, the S&P 500 lost nearly 57% of its value, impacting not only large corporations but also individual investors and retirees. Unemployment. Unemployment skyrocketed, with the U.S. unemployment rate peaking at 10% in October 2009. In countries like Spain and Greece, unemployment rates exceeded 20%, particularly among young people. The sudden rise in joblessness strained social safety nets and government resources. Global trade decline. The recession led to a contraction in global trade as consumer demand collapsed, businesses cut back on production, and credit dried up. Many export-oriented economies, particularly in Asia, experienced sharp declines in growth. Government and central bank responses. Monetary policy. Federal Reserve action in response to the collapse. The Federal Reserve slashed interest rates to near zero levels. They also engaged in quantitative easing, QE, purchasing large amounts of government bonds and other securities to inject liquidity into the financial system. Global central banks in Europe, Japan, and other major economies also lowered interest rates and launched QE programs to stabilize their economies. Fiscal policy. TARP, the Troubled Asset Relief Program. In 2008, the U.S. government approved a $700 billion bailout plan to purchase toxic assets from banks and provide capital injections to stabilize the financial sector. American Recovery and Reinvestment Act of 2009, President Obama signed this $787 billion stimulus package, aimed at jump-starting the economy through infrastructure projects, tax cuts, and support for the unemployed. Global fiscal stimulus. Many countries, particularly in Europe and Asia, implemented large-scale fiscal stimulus packages to counter the effects of the recession. However, this also led to concerns about rising government debt. Macroeconomic lessons from the Great Recession. The importance of financial regulation. The crisis highlighted the need for stronger regulation of financial markets. In the U.S., the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 introduced a range of measures designed to prevent another financial crisis, including stricter oversight of banks and financial products, as well as the establishment of the Consumer Financial Protection Bureau. Moral hazard and too big to fail. One of the key criticisms of the response to the financial crisis was the idea of moral hazard. By bailing out large financial institutions, the government may have encouraged future reckless behavior, as firms believe they will be rescued if they fail. The concept of too big to fail became central to the debate about financial system reform. Global interconnectedness and contagion. The recession showed how interconnected global financial markets had become, with problems in one country rapidly spreading to others. This has led to greater cooperation between international financial institutions, like the IMF and World Bank, to prevent future crises. Central bank independence and policy limits. The Federal Reserve's actions in slashing interest rates and using QE were critical in preventing a deeper recession. However, the crisis also revealed the limitations of monetary policy. When interest rates approach zero, leading to debates about alternative strategies, such as negative interest rates or helicopter money, direct cash transfers to households. Austerity vs. stimulus. In the aftermath of the crisis, many governments faced significant debt burdens. This sparked debates about whether to pursue austerity, cutting spending to reduce deficits, or stimulus, spending more to boost demand. Europe, in particular, grappled with this issue, with countries like Greece facing severe austerity measures in exchange for financial assistance. Long-term impact and conclusion. While the global economy eventually recovered, the Great Recession left lasting scars. It led to a re-evaluation of the role of government in financial markets, changed how central banks conduct monetary policy, and highlighted the importance of safeguarding against systemic risks in the global financial system. Today, the legacy of the 2008 crisis continues to shape economic thinking. From stricter financial regulations to discussions about income inequality, the effects of the Great Recession are still felt, serving as a reminder of the risks posed by unchecked financial excess and the importance of proactive government intervention during economic crises. Thank you.
Hello, this is Dr. Heath. Thank you for watching and look out for much more from Heath Social Studies in the near future.